Hello and welcome to the channel. My name is Patrick and today we're going to look at the 4 levels of traders. We go from the dumb money, the level 1, to the financial institutions, the mainstream money within financial institution. Then we go to finance smart money and then finally to the top level. What are the different trading methods they use at these different levels? That is the question I'm going to answer for you today. And much of this information comes from my own personal experience when I worked with the financial industry. With that said, though, when you have gotten the, so to say, my view on it, you can search and find this information to a large extent. However, if you don't know what to search for, you will probably not find it. And this will also explain the name of my channel, namely Cryptometrics. That is a name I made up, but it comes from something called econometrics. And econometrics, you're using the art and science of studying financial data. We also have this in other fields like chemometrics, which is applied statistics to chemistry. And that is where I started my career doing chemometrics for the big pharma. Then I transitioned to financial institutions and was trained in econometrics, and then I renamed that to cryptometrics because that is basically what I do. I apply these things to crypto. Before we start the journey, I just want to make it clear that there are no financial investing advice in this video, just me sharing my own thoughts and ideas. We will start with the financial mainstream institutional players. The dumb money, I will comment on them as we go through the levels, because the dumb money basically try to do something that they do on these different levels. It's just that they do it incorrectly. Or in some cases they do something totally on their own that no one else is doing. But most of the time they have read or seen something about how these investors and traders are doing it, and then they have tried to apply that, but there's some key points that they're misunderstood. That is the main difference. And I will point out some of those key points, not all of them, of course, that will take hours. And then as I promised in the member channel, I will also do more videos where I more detailed go through how are they actually doing it, how are smart money doing it, how are these unknown secret traders, as I call them here. I will give you some names and examples of them, but they're not so well known. Usually every 3 are the well-known players, but the real ones, the ones you really want to learn from, they're on level 4. So I often get questions, how do they do with technical analysis or TA? Do they use ascending channels? Do they use head and shoulder patterns? Do they use moving average? All those questions. So I will do a separate video about that as I promised. Today is to give more an overview. So let's start with level 2 here, the mainstream financial institutions. What is their main approach? Certainly there are multiple approaches, but I will cover the general approach they're using. And here the general approach is to following the trend. And I will give you an example of this, even though the example will come from an Ethereum chart. Not so many mainstream financial institutions are trading Ethereum, but that's not the point. The point is how they assess the market when they go in and out. And then I will point out the difference here between dumb money and smart money will come soon. So here we are with Ethereum daily chart. I will draw something called an Elliott wave, because that is a good illustration of how the mainstream are trading, because they're often trading with the trend, and sometimes these trends form Elliott waves, sometimes they do not form that. That doesn't really matter. There are multiple ways to assess the trend. But if it, for example, will be an Elliott wave, as we can see here with these 5 waves up in Ethereum as example, their typical entry point will be to wait for the trend to establish, so they will not be in early on wave 1. On the pullback, they do not go in, and then they wait to see that we are breaking this high here. And often if we get the consolidation and keep going up, somewhere here they start to add in, and then we might add a few times like this. And this Elliott wave, the third wave, is often called the mainstream wave because of this reason. And this is where the mainstream financial institution would join. They try to go with the train. They don't want to be too early. They see that as high risk. And they also know if they're too late, they will get dumped upon. Then when the trend goes up like this and they've done gains, they start to sell, but they don't sell everything, but they start to leave the market. Just as they enter the market with a few trades, they start to leave the market and divide it in a number of trades. And this is also the reason why we get this pullback here at 3, simply because they are now starting to exit the market, and then when they go up here, they keep exiting and keep selling. So they are trend followers. And if a market is going down for too long like here, they will then exit and try to find something else that's going upward instead. And this is also why I say that I don't think we'll see mainstream financial institution into Bitcoin until we break 150K or something in that area. How are the dumb money doing it? In the case they also follow the trend, which probably is the most common way for dumb money to also trade, is to follow trends. The difference is that they look at this uptrend and then they're waiting for it to be confirmed, and there are various ways to get it confirmed. But often, for example, they want to see that we're breaking previous all-time highs or previous highs. This is not all-time high, we were a little bit higher somewhere back here. So when we break this high, and then maybe they want a daily close, weekly close, or a retest that we got here and we bounced off of it. Here they start to buy. And if you do not believe me, go back to social media and look at videos from August of 2025 and let me know if people were buying or selling here. I tend to take notes of those things. I know that most people were buying. And they're also competing on being bullish. 8K, will it happen in 2 weeks or 2 months? That was really the topic, not really if we will turn down again or if it's a smart to buy here. That was a given. Now the trend is confirmed. So basically the dumb money that are trend followers, they just wait too long to confirm the trend in most of the cases. If we look at a slightly more advanced example, this is Bitcoin, and Bitcoin were also following a trend in the bull run, and it has been following the same trend for every bull run as a matter of fact. Here the smart money will also enter at some point in time, and here we also know that smart money did enter at some point in time, because after the opening of the ETF somewhere in this area, more and more smart money enters. And here there will be 2 options depending on what time frame you're working on. If you work with a shorter time frame, which still is usually years within financial trading or investing, they will simply keep buying as long as we follow this trend line, and this trend line is Euler's exponential, and they will just keep adding to the position as long as we follow this trend line. And here, when we break outside this confidence interval, they will say, now we've broken the trend, and then they might exit. However, if they are long-term holders, which we know that many of them are, they will not exit here, because they also, exponential also applies on the longer scale, with and without the correction, so to say. So most financial players that started here, if you look at the ETFs, they have not sold, because in their mind on a 10-year period, 20-year period, we're still in a bull run. So we have not broken the trend. We have broken the trend for this local 4-year cycle that we have had historically. But if you zoom out on the Bitcoin chart, we are in a global overall long-term upwards trend. And that is the reason why most of the financial institutions have not sold. They have sold less than the Bitcoin OGs actually. And in fact, the ones that weren't buying already have started to buy now. Not all of them. Many mainstream will come later. Most of them will not come until we break all-time highs, so 150K, 200K. Then we will get loads of financial people jumping on this. But the early adopters that are following trends, they are in, and they might have followed this trend, or they might look at the more global overall trend. So what is the difference with dumb money here? Well, often they use a moving average that perhaps have pulled tops in other markets. And if you've been on this channel, you know that we had one moving average crossing here, which meant that the bull market over. So here, the first wave of selling happened, and we concluded that we had a left translated cycle. This was a top and it was over. That was wrong. And then there was a new moving average crossing somewhere here. So then we had that again. Some moving average crossed here, they have it again. This one though was a little bit more correct perhaps. And then on the contrary side, we also have, because after some moving average crossed here and called the top, there were still like 10, 20 other indicators, whereof the pi cycle indicator by many considering the best one, that had not called any tops. And that one and most of those have not called any tops yet. So basically what happened was that most indicators called the top too early, or they have not called the top yet. And since this cycle was different, there were no blow off top that deviated from Eulerich's exponential like this, pretty much all indicators failed. And the main reason for that is that this frequency, how Bitcoin moved, is different this bull run than the previous one, which I told about already here and warned about already here, that all those indicators will probably call it incorrect in this bull run. So I think the key difference here is that dumb money will use indicators that worked previously without realizing that those indicators are built on mathematics that had certain prerequisites, and those prerequisites had changed in this bull run, and being unaware of that, meaning that you're using them but not under the same conditions, you cannot expect them to work again. So now we've seen some examples on mainstream financial institutions, how they're trading and investing, how the dumb money might have seen this, try to copy it, but why they fail and do not have the same outcome. And typically those institutions are in 5 to 10% annual returns. For example, S&P 500 has been in the upper here, 9 to 10%, but it usually has outperformed other markets in Europe and Asia, for example. And this is also where your 401 accounts, pension funds, and so on and so forth are placed. Now, what are the difference then if you go from level 2 to level 3, the smart money? And do we have examples here also? Because the mainstream is most financial institutions. Among the smart money, you have investors like Warren Buffett, for example, and Munger. All of those big names that you might have heard or read of, they often come here in level 3, which we can call the smart money. And they often have returns that are in the 10 to 20% area. And the ones I just mentioned, I think their track record shows they're about 20% in annual returns, which is then about twice as high as the general market, which compounded over years become a tremendous difference. And what is the difference here in thinking? Well, instead of being trend followers, they try to find imperfections where they think that something is undervalued if they're going to buy it, or overvalued if they're going to sell it then, obviously. And generally speaking, there's two ways to find overvalued or undervalued assets. One is through the chart, and one is through knowledge, industry knowledge within the area you're buying or investing. So I will give some short example of both. And once again, we'll go to Ethereum first, then Bitcoin, and then some other fundamental example that is very current with what is going on in the world right now, how you could be thinking if you were a smart money investor and were using your insights to find where to perhaps enter. But let's start with the chart example. If we look at Ether here again, we can see that Ether is following a trend line. Pay attention to here now how I've drawn the trend line. I have not connected the tops like this. I have not connected only the bottoms. Because if I do that, I'm using like 1% of the data. Some daily dips and some daily tops here is like 1% of the data. And those data also risk being outliers. In many scientific reports, the data they might be removing are outliers, the very highest and very lowest value, and then they use the rest for the analysis. Here, the dumb money are using those potential outliers to draw the trend lines, where the smart money will use all the data in here, which in this case is we have done a regression line, and then we have calculated the 95% confidence limits based on all the data. We have not connected the highly risky lows or tops. Highly risky because they just represent 1% of the data, and that 1% may actually be outliers that are not representative. Then we have a trend line that is going upwards. We have a center line here. So if I'm going to buy this asset when it's undervalued, I will simply buy when we are somewhere on this side here, because then it's undervalued. And I will sell when we are on the green side here, and the higher we are, the higher overvalued it is. So the difference here between the mainstream money that we're buying in this area will be that the smart money, they buy the dips. You might have heard the expression to be greedy when people are fearful and be fearful when people are greedy. or buy when there's blood on the street, buy undervalued assets. All these things basically mean the same thing. If you do it based on the chart, you're buying the dips. So you buy when we are low here, somewhere in the middle between the center line and the 90% confidence line. And then you sell when we are up here. And if you were on the channel, or if you go back and watch my old videos, what did I do? I bought here. When did I sell? I sold here. What did people do here? They competed about when we be at 8K, 16K. Some clown said 60K even. And then you can see that if you buy here and sell up here, in this example, you make like twice as much as ones who bought in the middle and were following the main trend, so to say. And that is the main reason why they do 20% instead of 10, because they buy lower and sell maybe higher or about the same place, but they go in earlier in the market. And one way to find those undervalued assets can be the chart. And it would be the same if it was overvalued. This is the oil chart. If you have been on the channel, you know what I did. I bought here. We have a trend line. We spiked out of this trend line. So what I did, I sold here. Since we have broken out from the trend line, it's overvalued, and then usually it's a good point to sell. If you're interested in this asset, you might go into it again when we're in the trend line. The trend line are after all going upwards. And often these trend lines have like 10 candles, 20 candles, 30 candles. We are following them, which means that most of the time they work. Of course, there will be one day where you buy here and then it goes down. But that is after 10 good days, you have one bad. So your win rate are pretty high if you're following the trends. How did we do with Bitcoin? We were buying every time we were below this line. The farther below, the more we were buying. Consequently, we get better entry points compared to if we only are following the trend. Now, there is also another way to do this, which perhaps is a little bit more the old school way, and that is to analyze the market and figure out what is potentially undervalued, what is a good buy. And I will also give you an example. This is just an example, so don't run and buy anything here. But let's say I'm sitting down here. I will just take you through the thought process that are used. Then it will apply different depending on which area it is. So ideally, you want to work with areas where you have some knowledge. That makes this a lot easier. The big players, the higher people that have the knowledge, they do not have. And then they let them do the analysis. Today, you can also use AI agents. But be a little bit mindful about that they mainly give you mainstream information. It's very difficult to get information from them before it is common knowledge. And when it's common knowledge, it's usually too late. But if you know what you're looking for, you can still use them. But if you ask them open question, most of the time you will get information that already is too late to trade on. But let's now say I'm sitting here and we have the crisis. I don't know if there is a ceasefire or not. No one seems to know. Regardless, we have this crisis, oil prices up. It's apparently too late to buy oil. We did that just in the beginning. Then I personally went out of it. Don't like to sit in oil for so long. But let's now think that I want to use this information. Oil is too late. Everyone already knows that. Everyone bought quite early. And then I might do some research and see what else is might there be a lack of in the world because of the conflict down there. And then there are some other things besides oil. And one of them, for example, is helium. And then if I have any knowledge about helium, I might be thinking, okay, kids can't have, their party balloons. Is that something to trade? Probably not. But helium are used in other places. It's used in electronic industries. It is also used in pharmaceutical industries. In pharmaceutical industries, it is used for a specific type of machine called NMR, nuclear magnetic resonance machine. And these machines are the closest things to what you can find in Star Trek, where they put a molecule in front of a device and then they get the entire molecule structure. Those NMR machines are doing that, even though it's much more complicated than it is it's like a puzzle, and then you have to figure out what molecule it probably is. Anyway, those things are very cool. They have a magnet there that is cooled down almost to 0 Kelvin, like minus 270 degrees. Well, 0 Kelvin is minus 273, but it's close there, not all the way down. And for that you use liquid helium to keep the core cold, and outside that you usually have liquid nitrogen just as an insulation to have less evaporation of helium. And these are used in basically all pharmaceutical companies and of course universities also doing chemistry or pharmaceuticals. And they're very critical since they identify compounds as one of the most powerful analytical instruments we have. And if you have a drug on the market, you might have as a criteria when you submitted this to FDA that one of the things you do on every batch is an NMR analysis. If you have that, you need to do that or you cannot sell your drugs. And the helium in these are evaporating, so if they run out of helium, this will be a disaster. So how could we use this information? Now I think we are in an area with information that most people do not know. You can of course try to figure out how do we use this. Well, for example, producer of these NMR machines, some of them have a recycling for helium, whereas others do not have that. The old ones do not have it, but some of the new ones have that. And of course, if any company is going to buy a new machine, they will probably add in a little bit extra money to get the one with recycling, or maybe they need to buy it because they're out of helium, have very little helium left in their reserves. So you might argue that more of those machines will be sold. You might look up which companies are selling these and which companies are not selling these. Maybe look up the market more than I've done here, it's just an example. And if everything looks good, maybe you take some long positions then in the ones who can benefit from a shortage of helium and also very expensive helium if there's a shortage of it. And then you might say to yourself, well, this stock is undervalued. I do not see it has gone up anything. Most people have not figured out this. I have, so I will go in and buy it before they run out of helium and before the quarter report show that this company is now getting more orders. And that is the way that most old school investors are looking at the market. They figure out which companies that are undervalued based on their business case. Basically, they have a strong business case, but the market have in their mind not really realized, and therefore they see it as undervalued and they go in and buy. So they have the fundamental approach and the chart approach to find undervalued assets. And of course, if you do that kind of analysis, you cannot be in too many applications or industry companies because you can't be expert in all of them. So often you see that they do not diversify as much as the one who follow trends. They might, many of them talk about 4 to 6 stocks or areas where you can do deep dives. And you start with one at a time and do deep dives and become good at it. And then you take the next area, so to say. And what is the difference with dump money here? Well, it simply is that they see something in the news and then they react on that. So they do the obvious trades that everyone else have already done. The smart money already did them days or weeks ahead of time. They see on the news, this is going short. This is the new thing that we are lacking of. This price will spike. And then they run and buy it. But once again, they end up buying the top quite often simply because the news were already traded on by many others already. And okay, then we have the level 4. What kind of approach do they have? The ones that are beating the market all over and over time. Once again, I have worked in 7 different countries, being responsible for the financial industry in those countries. Work with hedge fund, central banks, regular banks, all kind of trading institutions with different specialities. And in every country, it was the same. There were a few players that did much more than anyone else. I did not work in USA, but here I can name the player because they are pretty big and well known and easily to find reference cases about. Well, easily is a strong word because these players are usually quite secret. But if you look up Renaissance Technologies, founded by Jim Simons, a professor in mathematics and also an expert in cryptography, who went into finance, he and his fund beat Wall Street for 30 years straight, every year, year after year. And the return on investment were about 60% per year before fees, because they had pretty high fees. And their approach were quantitative analysis, which is not exactly the same as technical analysis, even though many things to believe they are the same. Technical analysis is a subset, I guess you could say, of quantitative analysis. And these customers are usually less known. Renaissance Technologies are not even very well known among the mainstream public. They're, of course, known within the financial world because they were relatively big and they were operating in America where everything is bigger. But these companies, including Renaissance Technologies, cannot become too big because then their trading doesn't work. So Renaissance Technologies, they had a long waiting list, and most people wouldn't ever get the customer, even though they begged to become their customers. There were only a very selected few that could be customers, in particular for their very best performing funds, which, if I remember correct, were called the Medallion Fund. And this is why you don't hear so much about them, because they cannot be too big players. Because when they do trade, they will move the market and destroy their own trading leverage, so to say. The openings they see, the disruption they see in the market, they are going to erase them if they move too much money. And in every country I've been, work with, every person I've talked to from other countries, they say the same thing. Oh yeah, I have this handful of smaller companies. They are just focused on quantitative analysis. They are cracking things like nothing else I've seen before, and they are just doing insanely good. And this is very much what my channel is about. Often when I'm showing you things, I'm using the same approach as I saw these people were using. And also they were the biggest client group to me, because the company I worked for, we were developing tools for advanced financial analysis. And the group most interested in that was level 4 here. And one key thing for them is that you develop and design, test indicators or other algos for each asset and for each time frame. So you might have something that worked for Bitcoin on the daily time frame. You cannot assume that work on the 4-hour, 15 minutes, weekly time frame. Often they work on a few time frames, but not very many. Often they work on some assets, but not a wide range of them. So it's a little bit like in medicine, they talk about individualized medicine is individualized trading, that each individual, the asset, needs to take care of in an individual manner. So when I hear people having those general indicators that work on all time frames and all assets, I know that I've never seen that everywhere, not even among the level 4 trading companies. So I do not actually think they exist. But if someone have figured out something which can be easy, sometimes it can be two moving averages flip-flopping, or it can be some mechanical rules that every day when we have a greed candle at the 50-minute chart at 11 o'clock, it means that we will end zero. So it can be very simple things or more advanced things. But when I see someone say, I have this, it works on the 4-hour chart for Solana, but only Solana, then I get interested, because then there's a chance that actually do work. And here we also come back to what I said before, that 99% of the top indicators in previous markets, previous bull runs on Bitcoin, did not work this time around. And that the reason I could call that so early was because I'm very well aware of that certain prerequisites of the market, if they change, which indicators are using those prerequisites in the calculation. And I could see that pretty much all top indicators that are used on social media were using those things in their equations that had been changing in this bull run, and therefore they should theoretically not work. I can give you an example here also, where you can see some differences. This is from Bitcoin chart in March 2025, beginning of March. We had been holding this support, and if you were on the channel, you know we're trading this. Then here it broke and we went down all the way here. So the question is this a V-shaped recovery or what is going on here? We got an uptrend, and if you go back and watch videos from this time area, what happened here? People said we have an uptrend. We had the support level at 92. We have an uptrend. We need to confirm the uptrend. A daily close above the support. That is a confirmation signal, people said. If you were on my channel, you know what we said. Daily closes, we have looked at them. They are not confirming nothing. Statistically, they mean nada. Which is not surprising, because Bitcoin trade 24/7. We happen to have a time during the day where we start a new candle. And on some charts, that time is even different depending on where you live in the world. People might have set them to different time zones. So how will Bitcoin know that? They decided to close the candle now. Oh, I need to behave differently. Instead, we have another set of rules that were not fulfilled, so we said this will break down again. So we sold here instead when others were buying. And the difference is that we have a set of rules that we have tested and seen that they actually have some statistical validity, and then we forward tested them, used them live in trading to confirm that they are in fact for the most time working. Not all the time, but for the most time. And those things might change. They might work for a while and then disappear. Then we need to find out some new rules. So the difference between dumb money and the level 4 basically is that they do assumption that they have not tested. They assume that a daily close means something, but they have not done the statistics to see if it do mean something or not. And also the trend followers were waiting for the trend. So this big green candle, they got very greedy. I'm missing out. I need to go in now. And then it turned south. And as I understand, there are of course a lot more to say both on level 3 and level 4 here. But basically, if you follow my daily content, this is what I try to bring to the table every time I do a video. And then of course, if you're a member, then you get more details, but you get something regardless. And as I said in the beginning, the difference between dumb money and the smart money is that the dumb money try to copy something, but they don't copy it correctly. In this case, they have rules, technical analysis rules, that haven't been validated, they're actually working. And as I also said, I will come back more to this. I have seen some questions in the comments about how are people trading, what kind of technical analysis are used by bankers, and just as important, what is not used, and what else are they using? Because on level 2 and level 3, they use quite many things that I don't use too often, because they are built upon that you have a diversified portfolio. So they do rebalancing, they are calculating Sharpe ratios, Sortino ratios, all kind of these things to look at the risk versus reward or risk adjusted profit and those type of things. When you move up to level 4, that might more often be on an individual asset, even though you might use multiple assets and all kind of data. These level 4 traders also often build hybrid models, meaning that they both take quantitative data from the chart, but also other data. It can be sentiment data, can be social media data, even the weather. I know some are built in because they saw for some assets, if the chart looked in a certain way and there was sun outside, then people were buying. If it was raining, they were buying a little bit less. So they do hybrid modeling where also other parameters and data comes into play. I think this is it for the overview. I will come back with more deep dives in all of these, and also in most of my daily updates. Well, I don't do updates every day, but in most of my updates, we are touching on these things that I mentioned here today. So hopefully it gives you a better view, a better overview about what I'm trying to achieve for myself and sharing with you at the same time. Thank you all for watching for today. If you made it all the way to the end, I know this is heavy things. Most people will not make it here. That is why they stay on level 1. And if you did, please write in the comment level 4 something so new that you watched to the end. Thank you all for the support. Thank you for watching, and I hope to see you all soon again.